Trump's Liberation Day becomes investors' worst nightmare. Indian automakers finish FY25 on a high, and why I find a fantastic investment opportunity in Oracle. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Sunny in London here, but I know that I have been late by about 24 hours. Uploading it on the record video is being recorded on Wednesday rather than Tuesday. Sorry, guys. Came into a couple of really important meetings related to my work and so on. So I had to take so I had to delay the process by 24 hours. But then again, I was like, either I do it delay 24 hours or not do it at all. And clearly, the second was never an option. So here I am 24 hours later, but I promise you we'll be back at our usual Tuesday timings from next week onwards, unless I find yet another unforeseen meetings. Anyway, the more important thing is I'm here and let's ready to go. Had some, as they say, better late than never, right? Especially when the week gone by was one that not only created history on Wall Street, but probably set the foundation that would reshape the world when it comes to trade and globalization. I mean, how can I not do a show this week, right? I mean, it's about the week gone by. My word. I'm, of course, talking about President Trump's Liberation Day that took place on last Thursday, April 2nd, and one that wiped out trillions of dollars from the stock market as the reciprocal tariffs came in much harsher than expected. There's no way I was going to delay this episode by another week after everything that's been happening last week. I was like 24 hours, don't care. I'm going to do it because it's important that you guys know. It's important that you guys understand what a tectonic shift global trade has gone through thanks to the so-called Liberation Day. Was it really Liberation Day? We're about to find out. Literally, all I can say is everyone was caught off guard. We're talking about economists, traders, analysts, consumers, internet, foreign government officials, US government officials, apart from President Trump, of course. Everyone was caught off guard at the extent of these tariffs. And the end result was one that pushed both the S&P 500 and the Dow Jones into steep correction territory and tech-heavy NASDAQ into what is known as the bear market territory, which is a drop of 20% or more from its recent highs. Once the dust had settled, and I want you to keep in mind that I'm not making a typo. I did not make a typo, or I'm not saying this. I'm not misquoting the numbers because you would probably think about it when I tell you the numbers. So once the dust settled, all three indices, no, unsurprisingly, were deeply in the red. Dow tumbled, get this, 7.9% for the week. When is the last time I told you about this kind of a decline? The S&P 500 fell 9.1%, and the tech-heavy Nasdaq declined 10%. Yeah, I'm not misquoting these numbers. Had to double check it twice before while I was writing the script. Had to triple check it again just before recording. I'm definitely not missing. Dow tumbled 7.9%, S&P 500 fell 9.1%, tech-heavy Nasdaq declined 10%. And you really thought I was going to delay the episode by a week? Absolutely not. So without further ado, let me quickly welcome you to the Doctor's Weekly Snapshot and give you my take on the so-called Liberation Day, or was it really liberation? Liberation for whom? And what to expect going forward when it comes to the United States markets, and forget about just the US markets, what it means for the rest of the world. Forget even stock markets, what it means for consumers across the world as globalization is undergoing a dramatic shift. First things first, let me take you through the actual tariff structure to give you some context. So basically, Liberation Day saw a 10% tariff being imposed on all imports from countries outside Mexico and China. So that was the baseline. The baseline was 10%, and that went into effect on April 5th, 2025. For countries that were charging the US higher tariffs, and this, when I say this, for countries that were charging the US higher tariffs, this is according to the Trump administration. According to the Trump administration's analysis, if they identified countries that were charging the US much higher tariffs, then they were slapped with far higher tariffs than 10%, tariffs in excess of 10%. Although the Trump administration decided to be gentle, President Trump said he was being gentle. And basically what these countries faced was half the tariff rate of what they were charging to the US based on models. This is very important, not based on, not based on some independent economists. No, based on models the administration officials had created themselves. So based on what they found, what administration officials found, if the if basically so something in my pocket. If basically the Trump administration officials found that they were charging higher rates, higher than 10% for sure, then they're going to be slapped with half the tariff rate of what they are charging, what the country is charging. So let me give you an example. The EU, the European Union, got slapped with 20% tariff. China got an additional 34%, taking the total tariff rate on to 54%. And just to give you a quick update, today it went, I mean, all these reciprocal tariffs, the higher tariffs have gone into effect from starting midnight today. Okay, so as I'm speaking, they've already gone into effect. And for China, there's a little bit of an extra. He has been charged with, President Trump has charged China with an additional 50%, and that has taken the total tariff rate on China to 104%. And as I was about to record the show, I just found out that China has now slapped the United States with reciprocal tariffs of 84%. They call it retaliatory. US calls it reciprocal. China calls it retaliatory. Retaliatory tariffs 84%. So nobody's backing down in this US-China trade war. You already know the playbook that happened in 2018 when it was US-China trade war. It was not a global trade war. It was primarily US-China trade war. But this time, all the gloves are off. All bets are off based on at least the data that I received today morning. China slapping the United States with 84%. And after US increased the tariff from 54 to 104%. Clearly, markets are taking it beautifully. They're taking it so beautifully that they're deeply in the red once again. India got a 26% tariff. More on that next week, not this week. Next week, I'll explain to you later. And Vietnam got slapped with 46% tariff. These are just some of the examples. By the way, you have Indonesia with 32, other countries with 27, another one with 35. So they've got a whole a whole bunch of reciprocal tariffs across the board. But these are some of the key examples that I've taken. But you get the picture when I say they were far worse than anyone, economists, traders, fund managers, government officials expected. And not to mention, it has gotten a whole lot worse since April 2nd, especially after China slapped with after the US took the tariff rate on China from 54 to 104, and China today morning, as I'm recording this, went from, they said they initially had done a retaliatory tariff of 34. Now they're saying we're slapping you with 84%. So clearly this story is far from over. Now, when you get worse than expected tariffs, the kind that have the power to trigger a global trade war, as can be seen based on today's developments as well, and subsequently increases the odds of a global slowdown, economic slowdown, or worse, a global economic recession, there can only be one end result, and that is pandemonium and chaos. Let me rephrase. Total, unadulterated, 100% pandemonium and chaos. And that's exactly what transpired. The tariffs led to a massive sell-off on Wall Street with over $6.6 trillion in market value erased in just 2 trading sessions. Again, when is the last time you've heard me speak? I've been doing this for 4 years, guys. Nearly 4 years, the show. Been doing investing for far longer than that. $6.6 trillion in market value absolutely wiped out in just 2 days. The Dow Jones Industrial Average fell by more than 3,000 points, while the Nasdaq entered a bear market, as I mentioned earlier, dropping 20% from its previous high. S&P 500, again, like I said, sank 9.1% for the week. Now, the decline was broad-based. No sector was spared. Banks and brokerage firms were among the hardest hit, while consumer staples and home builders were relatively less affected because there was a rush to safety trade. Every time rush to safety, people cannot live, people are not going to say goodbye to toothpaste and toothbrushes and soaps and utensils and dishwashing liquid and all of that. So clearly consumer staples are safe. They still were in the negative, but they were less affected compared to other sectors. Major tech companies, the Mag 7. What Mag 7? It was clearly not just the Lag 7 as the nickname. It was practically bruised and broken 7, I would say. Apple, Meta platforms, so significant losses. In fact, Apple is continuing to decline as we speak, and it's gone from a high of $250 to now about trading about 183 or the low 180s, or even would have hit the 170 target right now after China slapped with 84%. So clearly, Apple is one of the worst hit based on whatever is happening related to global reciprocal tariffs and retaliatory tariffs and so on. Investors obviously sought safety in government bonds, causing the 10-year yield to plummet. Now, the 10-year Treasury yield dropped below 4% for the first time in October, signaling heightened recession fears. Now, obviously, US government loves it when the Treasury yields go down because that would imply lower borrowing costs. But clearly, they don't want it going down when because the odds of a recession has just gone up. No, that doesn't benefit them at all. So in the long run or in the short term for that matter. So definitely not at the expense of a stock market rout, definitely not at the expense of economy. The thing is, the Treasury yields have gone from nearly 5% to now they're trading about 3.5, 3.7, I believe, the last time I checked. I could be wrong, but at the time of recording, it was anyway below 4%. Economists have definitely increased the recession forecast, with some predicting a 60% chance of a global economic downturn. These numbers will change next week when I talk about it. I'm pretty sure it would be some of them might even say 100% we're heading for recession. Don't be surprised. This is a developing story. It's a developing theme. One episode is not going to cover it. Like I said, it's going to be probably part 1, part 2, part 3. It's probably going to be even more than the Fast and Furious sequels. 10x, maybe I'll be speaking for the next 3 months about this. I don't know, because it's a developing story, and as investors, you need to be you need to keep, you need to be updated. It needs to be dynamic updating, as opposed to, oh yeah, I'll check it in 1 month. No, it's got to be week in, week out updates, because that's how much dramatically it's changing. In fact, not even week in, week out, it's changing day in, day out as well. Now, the tariffs are obviously expected to lead to higher prices and weaker growth. Fed Chair Jerome Powell warned of higher prices and weaker growth, but indicated that it's too early to determine how the Fed will adjust interest rates. Having said that, there are other Fed officials who have come out and spoken to the press on Friday, Monday, Tuesday, saying that the Fed had not projected these sort of rates into their economic models when it comes to interest rates and economic growth and so on. So clearly, even the Fed officials are clearly they're rattled. It's no doubt, I'll probably be underselling it by saying they're rattled, but clearly they are. Now, markets are betting on rate cuts later this year, and on Friday, both the economists and Fed were proven right when China retaliated with a 34% levy on US goods, further escalating tensions, and those tensions have now escalated even further today morning when, like I said multiple times before, 84% retaliatory tariffs after the US said 104% tariffs on China will be imposed starting at midnight. In fact, they already have been imposed. The Dow on Friday itself dropped about 2,200 points in a single day. No typo. I'm not saying it, but just kind of giving you the, I have to keep repeating how much the markets went down by, because it's been a while since you guys would have seen these numbers. Definitely not once since the markets have, not even in 2022, we've had this kind of massive decline since the show started. So yeah, I just have to keep repeating. Just let you guys sink in. I mean, you could see a lot of dynamism in my body language. Clearly, I think I'm getting out. I'm trying to stay. I've got to do a show. I can't do a show by crying, right? So I've got to be. So this is why you see, oh yeah, a lot of going fast and fast pace and so on. But don't get me wrong, these are not fantastic times. These are not great times. Now, what was crazy about all of this was that we even had a jobs report last week that was much better than expected. On any other week, it would have definitely led to buying in the markets. Unfortunately, it was on the exact Friday, the Friday after Liberation Day, the Friday when China said we will do a 34% retaliatory tariffs, that has now gone to 84. To be fair, I think if it weren't for the jobs report, the Dow may have declined even more than the 2,200 point drop it experienced in a single trading session. No way to know this for sure, but the labor market was that solid. It was that good. Investors simply didn't pay much attention to it. More specifically, the United States, the US economy added 228,000 jobs in March, surpassing the average monthly gains of 158,000 over prior 12 months. Healthcare and transportation sectors were among the strongest, with healthcare adding about 54,000 jobs. While the unemployment rate did tick up to 4.2%, the increase was modest and it did reflect reflect what everybody was thinking. The labor market for now continues to remain resilient. Services sector hiring picked up, particularly in industries like healthcare and transportation. Federal government employment declined by 4,000 due to the layoffs, though these were limited by court orders. Remember, the court orders still say that they need to be reinstated. Now, the Supreme Court has said for certain agencies, these rules of, the court orders that means that says that workers need to be reinstated doesn't hold anymore. So that was how that happened yesterday. That happened. So again, just giving you a live update on it. So labor market, would it be as good next month? All bets are off again. Stellar jobs report for now, but really unfortunate timing. So a lot of hand movements, a lot of market numbers, a lot of absolutely crazy market numbers. What do we make of all this? Remember, I told you last week that American exceptionalism is not dying when you consider it from a long-term perspective, right? Did a whole episode, whole segment on that. And I told you that April 2nd was not going to change that. I stand by the statement. No matter what, no matter how crazy the market reaction was, no matter how crazy the, people think that these tariffs are, no matter how, kind of how much fear has been instilled in economists, analysts, fund managers, consumers, all of them across the world about that we are heading to a global recession. Take all the negatives, and I still stand by the statement that American exceptionalism is not dying for the long term. Even after $6 trillion was wiped out on Wall Street, I am still saying it is not dying. I mean, Wall Street Journal called Thursday and Friday's market sell-off as an epic two-day rout. Even after that, I'm saying the American exceptionalism is simply not dying. To be fair, if one looks at what has been happening in the last 2 days of the current week, so basically Monday and at the start of Tuesday at least, then one would see that investors are slowly starting to get back into the market. There was some buying. Monday was good. Tuesday morning was good, but then it kind of slipped towards the end. Today we're back to the red again, but you'll obviously seeing a lot of zigzag, but there is still certain buying going on in some certain trading sessions. Now, in a traditional bear market, obviously it's not every it's not going to be down days every day. There's going to be some buying options, buying happening, as in some days the trading sessions will finish in the green. But what I'm trying to say is there are investors out there who still believe in the long-term buying opportunity. They do know that there is a possibility that in the long term things will stabilize. Me being one of them, I still haven't opened my cash allocation. I still haven't opened my checkbook. So as they say, still have got cash waiting to put it into the markets. But I'm yet to wait. I'm just waiting for the opportune time once things stabilize a little bit more. I'm still uncomfortable with the all sorts of instability that is happening. So, but like I said, that buying has been happening. At the same time, Trump administration officials are already announcing that there might be deals to be made, which has sort of brought back some positivity in the markets. According to technical indicators, RSI in particular, the relative strength index in particular, the rout has put nearly 50% of the S&P 500's constituents into oversold territory. This cannot be surprising, given that the S&P is in deep correction territory. Does that mean we go full guns blazing into the market? Absolutely not. I mean, there is no way anyone can perfectly time the market. If they could, then everybody would be billionaires. In fact, I think billionaires stay billionaires because they're not foolish enough to attempt to time the market to perfection. Nobody can do it. I think it's very foolhardy if you try to time the market every single time and in the hope that you will be right every single time. It doesn't work that way. If you are a long-term investor, then when you see a route like this, a route that you've not seen in a long time, especially, it is important that you not panic. And again, it's easier said than done, but that would be my take. My take is not to panic, but to focus on high quality names that have just got really, really attractive and start building positions in the name now. Take the Mac 7 constituents, for example. You really think NVIDIA is dying? You really think the likes of Meta and Microsoft are dying? You think the whole AI revolution is dying? Yes, there might be slowdown in capex spending, as they might close the taps a little bit to navigate the current macro environment, but I doubt it's going to be significant given that none of the Mag 7 companies, none of the hyperscalers, none of the AI related names can afford to lose ground. And all the Mag 7 constituents are in, pardon my French, pretty deep crap. Time to look into these names? I'm not a registered investment advisor yet. So all I can say is if I were me, if I were you, sorry, of course I am me. If I were you, I would. And I'm already looking into these names to see which one I can add to. I do have, I'm very enticed by the route seen in NVIDIA, the route seen in Amazon, and also the route seen in other AI's names like take Salesforce, for instance, Adobe, for instance, Oracle, for instance. All have been absolutely pummeled to the ground. I'm starting to look into these names again to see, and once things I'm not saying completely stabilized, but some sort of stability comes into play, then, I would look into adding these names. Of course, I will let you guys know when I do that. But I'm not going to put all my capital into the markets in one go. That simply doesn't work that way. Dollar cost averaging is the way to go. A point I raised even last week. Liberation Day may have wiped out trillions and caused a bunch of people to bring out all kinds of memes and jokes. Don't know whether you've seen Liberation Day memes and jokes. My dad keeps sending them to me. Hilarious, I would say, some of them. And I even ask him, where on earth do they get this? But do check them out if you can. So, Liberation Day, I think everybody's trying to find some humor amidst all this chaos and chaos and Armageddon, so to speak. But if you're going to be a long-term investor, guys, this could be an opportunity of a lifetime. And with more twists and turns expected, and with the CPI print as well as the Q1 earnings about to kick off this week, the opportunity of buying for the long term could just become a lot more attractive. Let me be very clear that in this current upcoming earnings season, a lot of companies are going to pull their guidance, as in they're going to say, we're not going to give you the full year guidance because of economic uncertainty. Delta released their earnings just this morning. They did the same thing. And I'm saying, I have a feeling Delta is not going to be the only one. So I'm just going to put it out there, but long-term buying opportunity, I think this is the opportunity of a lifetime, in my opinion. Whether you grab it or not could determine whether you make or break the chances of long-term wealth creation. More tariff-related, more Liberation Day-related commentary next week. But for now, let's head to the next segment, The Doctor Goes Home. Now, we're in the Doctor Goes Home segment. I'm very aware that you guys are eager to know my take about what impact President Trump's Liberation Day has had on the Indian markets, especially given that there was considerable sell-off in the markets over the last couple of sessions. In fact, there was some buying yesterday, but we're back to selling again. But I'm going to put a pin on this until next episode. And this is because the RBI's MPC meeting just ended this week, today actually. It was Monday to Wednesday, and they have announced a 25 basis rate cut. So that's good news. But there was still market sell-off. I need to study all of this and study the RBI's takeaway and so on. It happened literally in the morning, just as I was about to record is when this happened. But so I want to basically give you guys a proper holistic picture after factoring in the RBI's decision with respect to rate cuts, and then combine it all together and give you a more holistic picture. I mean, the question of will they, won't they has already been answered. They have done it. They've cut rates by by 25 basis points, again, making it a total rate cut of 50 basis point. But I'm going to study it. I'm going to put that factor in. I'm going to analyze it. I'm going to see how this is going to affect the whole 26% impact, tariff impact that has on the Indian economy, and what it means for Indian investors like you and I. And so I'd rather tell you guys the full story than leaving you feeling incomplete. Like, I don't want to leave you guys on a cliffhanger. So I'm going to put a pin on this. Until next episode, I promise you I will discuss the tariff-related impact on the Indian markets next week. But this week, it's a new month, and it can only mean one thing. It's time to take a deep dive into Indian automaker sales for the month of March and for the entire fiscal year. Keep in mind that President Tariff, oh my God, I just generated a meme just like that. President Trump has already imposed 25% tariffs on any auto imports and got some commentary on that. What is ironic about the latest auto sales is that for all the talks about exports getting negatively impacted by President Trump's tariffs, FY25 was actually the year of exports, as the Indian automakers' exports hit a record. India's automotive sector exported between 755,000 and 765,000 vehicles in FY25, marking a 12 to 14% increase year over year over the previous year's 672,000 units. This surpasses the pre-pandemic record of 676,000 units in FY19. So all the way back in FY19, that record, the export record, has been absolutely battered. Moreover, despite a demand slowdown, India's domestic passenger vehicle sales reached a record high of about 4.34 million units in FY25, marking a modest growth of about 3% from the previous year's 4.22 million. While the growth is modest, given the recent slowdown we've seen and given the nightmare start to 2025 that Indian automakers have been facing, the growth nonetheless makes it very impressive. The growth as a result of all of this makes it really impressive. Now, obviously, I'll be talking about the future in a bit, but for now, all you got to know is FY25 record exports and domestic sales. Even though it's a modest growth, it still came in very impressive after you account for or after you factor in the nightmarish start that Indian automakers have had in 2025. Let's get to the top car makers individually now. India's largest car maker, Maruti Suzuki, reported a 3% year-on-year increase in total sales, reaching 192,984 units compared to 187,196 units in March of last year. Domestic passenger vehicle dispatches were about 150,000, little under 151,000. It marked a slight decline of 1% compared to March 2024, but exports absolutely smashed it out of the park, coming in nearly 33,000 in March 2025, up from 25,892 units in March 2024. For the fiscal year FY25, Maruti Suzuki achieved its highest ever total sales of 2.23 million units, and this includes record domestic sales of 1.8 million units and exports of nearly 333,000 units, marking a 17.5% increase over previous year's exports. The company clearly the 1.79 million was its highest ever exports. And overall, when you factor in all together, Maruti Suzuki comfortably maintained its leadership in the Indian automotive market with strong export growth and stable domestic sales despite some segment-wise decline. The mini segment clearly continues to suffer as Indian consumer continues to prefer SUVs over the mini segment. But despite these segment declines, Maruti's leadership remained intact. Hyundai Motor finally returned to growth, reporting a 3% year-on-year increase in total sales, reaching 67,320 units in March 2025 compared to 65,601 units in the same month last year. Domestic dispatches to dealers were 51,820 units in March, slight decline from the 53,001 unit in March 2024. Exports rose to 15,500 units in March 2025, up from 12,600 units in March 2024. The Hyundai Creta was the best-selling car in India for March 2025 with about 18,100 units sold, and it also became the top-selling SUV in the fourth quarter of FY25 with cumulative sales of nearly 53,000 units. The Creta achieved its highest ever annual sales of 194,871 units in FY25, marking a 20% year-on-year growth and making it the third highest selling passenger vehicle in India. Hyundai's SUV lineup, including Creta Electric and the new Alcazar, contributed significantly to the company's sales, with SUVs accounting for a whopping 68.5% of domestic sales in FY25. Moving on to Tamo, the one that continues to suffer, probably a scenario that you're getting very familiar with in recent months. I've been saying Tata Motors continues to suffer. This is getting a theme that is getting, well, as an investor, getting pretty annoying. Still haven't sold, but it's still in the penalty box for me. Tamo reported flat domestic sales of over 90,500 units in March 2025, slightly down from 90,822, but overall it's flat. It's marginal decline of 0.3%, which let's just call it flat. PV sales, including electric vehicles, increased by 3% to about 52,000 units in March 2025, compared to about 50,300 units in the same month last year. Tata Motors' total sales for FY25 unfortunately declined by 4%, unlike Maruti and Hyundai, which both registered positive sales. It came in at about 912,155 units, and in FY24, it was about 949,015 units. PV sales declined by 3% to 556,300 units from about 573,500 units in FY24. Despite global headwinds, TAMO anticipates sustained growth in FY26. Anybody can anticipate a growth, but I'm not sure how it's going to go because JLR is also not doing particularly well. So it's a close. If you are a Tata Motors investor like me, then it is time to closely monitor the stock, not for the good things, but to make sure to see whether probably trim the position, reduce the weightage of the position in your portfolio, or even sell it outright. Not now, but I would be closely monitoring. Company says it anticipates sustained growth in FY26 because of factors like higher fleet utilization, financial support from rate cuts, lower crude oil prices, and increased infrastructure spending. Yeah, sure, lower crude oil prices is great, but lower crude oil prices can also mean recession. What are you going to do then? So that's sort of a problem, sort of a worry. So definitely the company remains in the penalty box, and I really think that you should put it in the penalty box as well. The company, however, did say that it is mindful of potential impact from new regulations. I'll get into that a little bit, such as those mandating truck cabin air conditioning, which could affect vehicle prices. And there are other regulatory things as well that I'll get into it towards the end of this particular segment. Now, my new favorite in the market, Mahindra & Mahindra, keeps defying logic as its stock continues to get absolutely crushed despite continuing to post stellar numbers. It's something that drives me nuts. It completely baffles me, completely has not had me rattled yet. But I always wonder, when I look at my portfolio, I always wonder what is going on with this company. Why are investors so negative on the stock? March was no different. Stock crashed, but the company reported an 18% increase in domestic PV sales, reaching nearly 50,000 units compared to about 41,000 units in March 2024. Including exports, total PV sales were above nearly 51,000 units, marking a 23.5% year-over-year growth over the previous year's previous year's total of 41,161 units. For FY25, M&M achieved a record 551,487 units in domestic PV sales, representing a 20% year-on-year growth from 459,877 units in FY24. Mahindra sold 48,048 SUVs in the domestic markets in March 2025 alone, and that represented a growth of about 18% from the previous year. The segment contributed significantly to the company's overall sales. The company also started deliveries of its electric SUVs, which have seen strong demand momentum. And now you can see why I'm confused with the whole stock market reaction. Exports surged by 425.9%. Again, not misquoting numbers, but clearly the lower base, 530 units in March 2024. Now they've got about 3,000 units in March 2025, contributing the overall growth in passenger sales. The company is poised to continue its growth trajectory with new models and technologies, particularly in the EV segment. The company is not saying it, unlike TAMO. I am saying this, which makes the recent sell-off an absolutely bonkers scenario, a crazy scenario. But I think investors have a golden opportunity to get in the name at these levels. I mean, it's trading nearly below 2,600. I mean, it doesn't make any sense to me. I mean, my previous target was 3,300. I haven't bumped it up yet. But clearly, given the fact the strong demand that you're seeing in SUVs, I don't get it. I always look at it and I'm like, what is going on? So don't be shocked if I tell you next week I bought some more in M&M. So because clearly taking advantage, right? You got to take advantage. Right. Let's move on to two-wheelers now. Hero MotoCorp came back absolutely roaring. I've been telling you that it's been bad, but not in March 2025. As it reported a 12% year-on-year increase in total two-wheeler sales, reaching 549,604 units compared to about 490,415 units in March 2024. Domestic sales rose by 11% to about 510,100 units in March 2025 compared to 459,257 units in the same month last year. Exports grew significantly by 27% to 39,518 units in March 2025 compared to 31,158 units in March 2024. Hero's electric mobility brand VIDA dispatched over 58,000 electric scooters in FY25, and the company has established a robust fast charging network with over 3,600 charging points across more than 250 cities so far. It's continuing to build more. Hero MotoCorp achieved total sales of 5.9 million units in FY25, and that amounts to a 5% increase year over year, primarily driven by exports. TVS, a name that I continue to like in the two-wheeler space, had an even bumper year, achieving its highest ever sales in FY25, with total vehicle sales increasing by 13% to 4.74 million units from 4.19 million units in FY24. Again, in March 2025 alone, TVS Motor reported a 17% year-over-year growth in total sales, reaching 414,687 units compared to 354,592 units in March 2024. Two-wheeler sales grew by 16%, crossed the 400,000 mark, with motorcycles increasing by 15% to nearly 200,000 units, and scooters by 27% to nearly 167,000 units. Electric vehicle sales of TVS surged by 77% year over year. Finally, Royal Enfield saw its sales surge 34% year over year in March as it achieved its highest ever annual sales in FY25, with sales surpassing the 10 lakh unit mark. It's been an absolute blockbuster finish to the year for Royal Enfield and for TVS as well. For Hero MotoCorp, back to positive growth trajectory. How long it's going to be there, only time will say. Bottom line though, despite having a nightmarish start to 2025, as I mentioned earlier, it was an absolute blockbuster year for Indian automakers across the board when you take the overall picture, the year-over-year picture. Like I said before, the irony is that for all talks of exports getting affected by the new tariffs and reciprocal tariffs and all of that, FY25 actually saw Indian automakers generate record exports. Question now, is this going to be the best? Is this going to be the best for Indian automakers for the foreseeable future? Is this the best they can do? The good news is that not a lot of people think that auto tariffs that imposed by the Trump administration are going to have any impact on the automakers. ICRA, for instance, stated that these tariffs will not have a material impact on India's passenger vehicle exports, and it's because exports from India to the US represent less than 1% of the total PV exports. Indian auto component players, however, will suffer or are likely to suffer more. However, while the impact of the tariffs may or may not be minimal, domestically, Indian consumers are expected to face some pain, given that all major automakers have decided to raise prices. This is because, and here's the regulatory part that I was talking about, upcoming regulations such as stricter emission norms will require significant investments from the manufacturers to comply, adding to their costs. Furthermore, consumers are increasingly demanding more safety features such as 6 airbags across all variants, which adds to production costs. Factoring in all these elements, the industry expects a modest growth of about 1 to 2% in FY26, indicating a cautious outlook due to economic uncertainties, added production costs that will increase prices due to regulation and changing consumer preferences, and so on. The 1 to 2% modest growth also accounts for the high base effect from previous years as well. Indian automakers had a blockbuster FY25. The issue is that it looks very unlikely that they will be able to repeat this feat in FY26. What is interesting is that the factor that was expected to create so many problems, the so-called auto tariffs, may have nothing to do with it after all. With that said, to the final segment, Dr. dissects where yet another AI beneficiary goes under the microscope, one that has been absolutely pummeled in the recent Liberation Day related sell-off I'm seeing right now in my portfolio, and so on, red across the board. Company's logo is also red. Nothing to do with it, just a bad joke there. But the company I'm talking about is Oracle Corp, ticker symbol ORCL. The book is ready, by the way, for valuation. We'll get to it in a minute. Now, Oracle announced its earnings last month. The second straight quarter missed on both the top and bottom lines. More specifically, the revenues came in at about $14.13 billion. And while this translated to a year-over-year growth of 6.4%, the revenues missed analyst estimates by $259.2 million. Non-GAAP EPS came in at $1.47, up 7% year over year in constant currency, but missing analyst estimates by 2 cents. Both the revenue and EPS growth also experienced a deceleration compared to the previous quarter. Cloud infrastructure, however, continued to experience very strong growth driven by OCI, the Oracle Cloud Infrastructure, with revenues of the Infrastructure as a Service IaaS division growing 51% year over year in constant currency. Non-GAAP operating margins expanded marginally on a sequential basis, coming in very strongly at 44%. Finally, over the last 12 months, operating cash flows came in at $20.7 billion and free cash flows at $5.8 billion. For the next quarter, for Q4, management now expects total revenues to grow from 9 to 11% in constant currency, with total cloud revenues expected to register a year-over-year growth in the range between and 28% in constant currency. Non-GAAP EPS is expected to be between $62 and $66, which would translate to year-over-year growth between 0 and 2%, so flat to a 2% growth. Management in the fourth quarter expects currency headwinds of about 1 cent to 2 cents on the EPS and a 1% negative impact on revenues. Finally, they also announced that the company's board of directors had approved a 25% hike to its quarterly dividend, which would translate to about 50 cents per share from an increase from 40 cents per share, obviously 25% hike, right? Now, we're not here to talk just numbers. We're talking about, we're doing a deep dive analysis. And one of the key takeaways from Oracle's latest quarterly report was the continued strength seen in the company's remaining performance obligations, or RPO metric. The company with each passing quarter has been showing remarkable growth in this particular metric. Q3 was no different, as evidenced by the fact that RPOs at the end of the quarter stood at a whopping $130 billion, which translates to a year-over-year growth of 63%. To put things in perspective, RPO metric at the end of Q2 stood at $97 billion, a year-over-year growth of 50%. So 31% of the so 50% in Q2, and now it's 63% year-over-year. So growth in RPO is also remarkably growing well. It's heading in the right direction, positive. 31% of the total RPOs are expected to be recognized as revenues in the next 12 months, which translates to an impressive $40.3 billion. Finally, Q3 also marked the company's strongest booking quarter ever, as evidenced by the $48 billion added to the company's backlog. Now, investors have to take into account that the company has registered these very, very strong numbers without any assistance from what is expected to be the next growth driver for the company's IaaS division, Stargate. Now, Stargate is a $500 billion initiative launched by Oracle in partnership with OpenAI, SoftBank, and Abu Dhabi's MGX, with the aim to drive the next Gen AI development. While the company didn't put a definite timeline on when Stargate contracts would start coming in, Larry Ellison, CTO, merely remarking that the company expects our first large Stargate contract fairly soon. His quote, yeah, not mine. That's why this. The fact that the company has managed to grow its RPOs with zero assistance from Stargate, it does suggest that any contracts generated through Stargate would be a bonus to the company's top line rather than the primary driver. In other words, company is doing remarkably well even without Stargate, which means the future growth of the company should be much bigger, in my opinion, than what investors have factored in. During the earnings call, we did get some confirmation on the added boost that Stargate is expected to provide, as management announced that they are now more confident in hitting the company's $66 billion revenue target for FY26, which would translate to a year-over-year growth of 15%. Furthermore, the company now expects FY27 revenue growth rate to be 20% higher than the management's previous guidance. Does all this mean that Stargate's significance is diminished? Absolutely not. On the contrary, there is no doubt, in my opinion, that Stargate would be a significant growth driver for Oracle in the coming quarters. Moreover, now that the company has demonstrated that it can keep generating strong RPO growth, investors are likely to punish the company should this growth somewhat stall in the coming quarters. This is where Stargate has a major role to play, as it has the keys to unlock even more RPO growth and, by extension, revenue growth. It is therefore useful that the company has such a strong catalyst up its sleeve, and it should be even more reassuring to investors, in my opinion, that the company has not had to use this until now. One of the questions that companies like Oracle normally face is on how fast the data centers would come online to match the strong demand, as this would determine when the company can start generating returns on its AI-driven investments. The Q3 earnings call was no different. The positive sign is that the management believes that the component delays that have slowed cloud capacity expansion in FY25 are expected to ease by the first quarter of FY26. This would imply about 6 months, not an unreasonable timeline in my opinion, given that the company has been making very steady progress in recent months. For instance, Q3 saw the company bring its 101st cloud region online, the first time it has crossed triple digits. The company now also expects available power capacity to double in 2025 and triple by the end of FY26, which implies more revenue acceleration in the coming quarters. And it further justifies how the management was able to provide more clarity on its FY26 and 27 revenue targets. It's first takeaway. Other takeaway is how the company is ramping up all this capacity without really spending excessively. I mean, for instance, the company spends less on capex per dollar of IaaS revenues compared to the hyperscalers, Amazon, Microsoft, and Google, as it combines its ability to build smaller data centers at the start and then expand them based on demand, as well as the ability to standardize and automate inside the cloud to keep costs low. The higher degree of automation can be attributed to the company's Gen 2 cloud architecture, which has shown to offer more value compared to the typical Gen 1 architecture. In other words, the company's Gen 2 architecture is more efficient, which allows the company to manage its capex spend more judiciously and manage its expenses in a more disciplined manner, as confirmed by the improving operating margins with each passing quarter. At a time when doubts are creeping into whether massive capex spend announced by the hyperscalers would yield a sufficient return on investment, Oracle has been quietly ramping up its capacity without really going overboard with spending levels. The company still expects that its capex spend will be a little more than double of FY24's number, which would translate to a little over $32 billion. This figure is high, but when compared to the rest of the hyperscalers, after accounting for greater efficiency thanks to its Gen 2 architecture, investors can rest easy knowing that capacity expansion is happening at a pace that doesn't involve excessive spending. Book ready, pen ready. That can only mean one thing. Let's talk about valuation. Now, Oracle, according to LSEG data, let's do Oracle. According to LSEG data, currently trades at a forward PE of 19.3. It's making it cheapest among its peers. Last time I talked about Oracle, I'd assumed a forward price to earnings of 31.94 for my calculations. Since that time, Stargate has become an additional catalyst for the company, along with catalysts from that I mentioned the last time I talked to you, such as continued demand for OCI, partnerships with all the hyperscalers, maintaining a greater discipline while managing expenses and capital expenditures, to name a few. As such, I see no reason to alter my projected forward P of 31.94 for my calculations, no matter how much you can push back against me with reciprocal tariffs, but I just don't see them, I just saw in the long-term picture, I just don't see that happening. So forward price to earnings of 19.3 is where it is. I'm scratching that and I'm putting that back to my old 31.94x. Yeah, I'm scratching 19.3, putting it in 31.94. Now, the company generated $1.39 dollars in the first quarter, $1.47 each in the second and third quarter, and is expected to generate between $1.62 and $1.66. The company in the third quarter missed the lower end of the guidance and also missed my own estimate of $1.52. Given that the management expects currency headwinds to impact Q4 EPS as well, I'm going to adopt a conservative approach and assume that Q4 EPS matches the lower end of the company's guidance, which is $1.62. This would take total non-GAAP EPS for FY25 to $5.95, slightly lower than my previous price target of previous estimate of $6.18. Now, I've assumed FY26 EPS growth to match the long-term average. FY26 EPS growth equals long-term average growth, and that would be 11.97%, a reasonable assumption in my opinion, given how the company has been managing its expenses in a disciplined manner. And that means FY26 EPS would come in at $6.66, the devil's numbers. So FY26, $6.66. Now, so you take a price target of 31.94, right? Multiply this by 6.66. What do you get? What do you end up getting? You end up getting an updated price target of $213, higher than my previous target of $197, implying an upside of about 67.5%. So I'm not even joking. Thank you, reciprocal tariffs. You now have got Oracle at a far more attractive pricing point. Despite the significant, and I mean the monstrous upside from current levels, stock has been on a shaky ground when it comes to momentum, clearly. The short-term momentum grade of the stock stands at B minus, not particularly great. Overall grade, momentum grade also stands at B minus, not really great, according to Seeking Alpha's momentum scale. It's hardly surprising given that recent recession fears, tariff impact, reciprocal tariff-related sell-off, all of that, it's been a significant drag, not just on the Mag 7, but also on software names. As such, I am maintaining a buy rating. I'm not upgrading it to strong buy. I am maintaining a buy rating on this name, but I would be pursuing a dollar cost average if I were you. I bought Oracle clearly at a much higher price, so it is a bit on the red, not much. It's a bit in the red, which means I will definitely be adding in the coming days and weeks to my existing position. Just waiting, like I said at the start of the show, just waiting for the noise to stabilize a bit before I go in. So I will be obviously letting you guys know when I do that, but 67.5% upside, I don't see any reason why not to add to my existing position. Do your due diligence, not an RIA or registered investment advisor yet. Later this year, hopefully. Now, if it's a bull case, I still have to discuss the risk factors. There is no change to my main risk factor from last time, which is that there is always a possibility that spending on AI could slow down, and those possibilities have only increased thanks to recession-driven fears, which are related to Liberation Day. Well, this doesn't seem to be the case. I mean, doesn't while the recession, the odds of a recession are high, but the recession is nowhere around the corner, given how and while the spending on AI, slowing down spending on AI doesn't seem to be the case for now, given how strong demand for OCI has been, investors simply have to factor in the possibility of a slowdown, as it would have a significant negative impact to my bull case. The other risk is the increasing risk of an global economic slowdown again, which has subsequently definitely increased since Liberation Day. Given the, so while this is not an Oracle specific risk factor, given that any threat of a recession or a slowdown will negatively impact the software sector, this is yet another risk factor that investors have to consider. Finally, the investors like you and I, and even potential or existing investors, will also need to keep an eye on the stock-based compensation, which has shown a decline from 16% year over year to 14.3% year over year in Q3. However, the figure still remains high and is one that investors need to watch out for. Bottom line, on the face of it, Oracle had yet another disappointing quarter with both revenues and EPS missing estimates. However, when one does a deep dive analysis, the worries over the company's long-term growth should diminish. The company, even without a single Stargate contract, managed to generate $130 billion in remaining performance obligations, with a little over 40 billions of that expected to translate to revenues in the next 12 months. At the same time, companies' issues that were preventing capacity expansion are easing, with the company expected to see its IaaS revenues growing faster than the 50% growth seen last year. Moreover, with capacity constraints easing, management also offered more clarity over the future revenue growth, with FY26 revenues expected to grow at 15% and FY27 revenue growth rate expected around 20%. This is after accounting for the impact of Stargate contracts, which are expected to offer further boost to RPOs and subsequently to revenues in the coming quarters. The partnerships with all the hyperscalers remain very strong. Company has also managed to announce some new partnerships with all the major cybersecurity companies this quarter as well. To me, however, Q3 was all about the proof that the company continues to attract strong demand for its cloud infrastructure business, and there doesn't seem to be any potential fallout from the DeepSeek saga. The fact that the company is yet to pull the growth lever called Stargate should offer renewed optimism to existing and potential Oracle investors, no matter what Liberation Day impact is. That's all the time I have for you this week. It's been a long show, I know, but I had to cover the Liberation Day. It's a tectonic shift. You guys had to know. If you have a US specific, I've lost English now. I've forgotten English now. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHMVINAY, or email me on thestockdoctorpodcast@gmail.com. As things stand, we're back on our Tuesday timeline next week. Apologies again for being a day late, but I just couldn't, just couldn't not record it after everything that's what we've seen in the markets. Thank you once again for listening. I will see you next week. Until then, stay safe. Don't try to think too much about the tariffs and make some money.